Great. Okay. So let's go ahead and start with Anchor VWAP. So really, how many of you have been using VWAP in the past? Or how many of you have tried using it? Just mention it in the chat.
Used it, sir. Used it a while. Used it a while back.
Okay. Okay. Anybody else who's
And
used
even in
Anchor
trading
VWAP?
view, I remember in trading view, this anchored VWAP was introduced just 2 years before, if I remember.
Correct.
It's not,
Yes. Yeah.
it's not
It
very
wasn't there.
old.
Perfect. Okay. So really first, as we try and understand VWAP, we first need to understand, sorry, as we try to understand anchored VWAP, AVWAP, we first need to understand what is VWAP. VWAP is nothing but volume weighted average price, okay? Weighted average price. Okay, till now, whatever we saw was, if you looked at a graph, if if you looked at a chart, you had volume at the bottom, and you had these bars that would show you the volume, and you had the price, either in a line chart or candlestick on top of the chart. And if you wanted to put an indicator, you would probably just have that on the price chart. If you wanted to put a volume indicator, that you can do in TradingView, you just need to go over here, um, and then select whatever uh, indicator you want on the volume bar, and that indicator will come up over here. So they were all separate. You had OBV, you had Chaikin, money flow, etc. All that took into account the volume, but they did not give you one single price at which uh, you'd have a mix of both volume as well as the price at which that was being traded. So really what AVAP does is that it takes into account the volume that is traded at each price, and then gives you a line that tells you what is the average uh, volume weighted price at which all the trades are being done. Okay. It's mostly an intraday indicator. It starts at the beginning of the day, and it adds all the volume and prices during the day, multiply the volume by the price. So if there's one unit traded at 100, and there are 5 units traded at 105, sorry, 101, then it would multiply the price into the volume and then divide it by the volume. The volume over here is 6. Okay, so whatever that comes to. So that's how VWAP works. Now, anchored VWAP is nothing but the same thing as VWAP, but the difference really is that VWAP starts from the first trade of the day. Anchored VWAP is something that can take any starting point. Okay, if you read Brian Shannon's book, he has, I think, two books that he has published. I'm just trying to remember the names. Yeah, maximum trading gains with anchored VWAP, and technical analysis using multiple time frames. These are the two books that he has, and both of them really talk about anchored VWAP. Uh, if somebody is really interested in going deeper into this subject, just search for Brian Shannon on Google. He has a lot of videos where he is very nicely explained anchored VWAP. And thankfully, I got a chance to meet him in New York in 2023 during the 50th celebration uh, of CMT, and he was kind enough to actually open up his trading system and show us exactly how he was using it. So I was able to sit with him outside the actual presentation that he gave, and then sit and see how he's using uh, anchored VWAP on multiple time frames, not just on one time frame. He's looking at weekly, he's looking at daily, he's looking at monthly, and then going down all the way into hourly and 15-minute time frames. So, really, what anchored VWAP does is that you can choose the starting point of where your anchor will be, and based on that, the calculation would be the same. Okay, all the prices and the volumes that are being traded at specific price would be multiplied, and it will be divided by the volume for that particular period. Okay, so when we begin anchored VWAP calculations, what happens is that it gets anchored to the first price point, and that is referred to the anchored VWAP. In part two of this chapter, what we'll see is how do we determine where to place the first anchor. Okay, and there are some rules around that and the different thing that it tells you. But really, it's nothing different from VWAP. VWAP is a short-term indicator, which, or typically an intraday indicator, which looks at price movements from the beginning of the day. But anchored VWAP can start anywhere on the chart, and we'll go to trading view and see that. So anchored VWAP allows us to measure the VWAP from any point of reference, and that point of reference is called an anchor. Okay, so that's why anchored VWAP. So in the next one, what you see is that there are two lines. Okay, one is anchored to the beginning of the year. The second line starts at the high of any a recent move. Okay, and that kind of gives you two boundaries where the VWAP is. So this one is from the beginning of the year 2024. This one is at the top, and that basically shows you if the prices are moving within a range, if the prices are breaking out. And what you'll see is that in a lot of cases, this goes this way, and the prices narrow down. And if it breaks downwards, then there's a very sharp move downwards. If it break upwards, it will keep taking support. This VWAP will start moving upwards, and it will keep taking support from this VWAP and keep moving up. So before we go into the calculation, let me quickly take you to TradingView and show you what and how anchored VWAP looks like on TradingView. Okay. So this is VWAP. Let me first show you how to get VWAP. So go over here and volume weighted average price. That's the first thing that you see. We'll come to what those green things are. That's something called bands that is there later in the chapter. So we'll take a look at that. But this blue line is the VWAP. I can go into a 1 minute chart. And what we can see is that it starts from the beginning of the day over here. They've just shown this for continuity, but it really starts over here. And then I think this, what was this, 28th of Feb, which was Friday. And you can see that the market opened with a gap down, fell. That gap down is not actually shown in Nifty futures. So typically, when you're using VWAP, you need to have a product that has volume. If you use it on Nifty nowadays, TradingView does give you a view to understand how is it that volumes are behaving on Nifty, but Nifty is something that's not really traded. So it's always better to use any volume indicator on an actual volume kind of a security. So Nifty does not have volume. There is a way in which TradingView is calculating it. It might not be the best representation. But if you look at this over here, the market open gap down. It tried and came and tested the VWAP, fell. Again, it came and tested the VWAP again, and then it was rejected over here, and then it kept falling. Now, it's not always that the market will stay in one direction of the VWAP. Like over here, this was a day that was a non-trending day, but the VWAP was continuously going down, and every time Nifty moved towards VWAP, it got rejected and fell. Similarly, over here, on this day, the move was on both sides of the VWAP. So if you look at the start point, went down, went up, tested, tried to go up again, was pushed down, tried to go up, and then was pushed down again. And then after another test, it was able to break, but finally it closed below the VWAP even on Thursday. So that's how VWAP works. But if I remove VWAP and go to the daily chart, because anchored VWAP is typically on a longer time frame. You can use it on a shorter time frame, but what you want to do is to make sure that you place it at the right price point or the right point from where it starts. So on the left hand side, you can see all these tools, and here you can see anchored VWAP is one of the tools that you can use. So typically, this is something that we'll study in the next chapter, but I'll still go ahead and share. So if I look at, this is the peak. Oh, sorry, I picked up volume profile. Yeah. Um,
So this is
we
Nifty
place it.
future chart, right, sir?
Say that again.
Is it Nifty future chart
This is the Nifty futures chart. Yes.
of February?
Yeah. So this is a continuous contract. So, uh,
Okay.
yeah. Okay, but we'll do it on a stock also. So this is the March 2020 low, and this is how the VWAP has formed from there. And you can pick up. So this was the budget day low. Okay, and this is how Nifty has behaved. So from the top, it's come down below the budget day low, gone down. It tried to test that level again and was rejected and has come down. Let's see if I put it on a stock. So I'll probably just put it on Reliance. Okay, so this is the cash chart for Reliance. And what you can do is take a look at how it is behaving from here and how it's behaving from, I'm not sure what this day is, 17th of March 2020. Okay, so this is again the COVID low. Yeah, this is far back in the past, but you can see over here, at a lot of times it took support from the anchored VWAP and then moved up. Let's look at any other top. So this was a local top at that time. The market kept moving up and down from here, but here it took support and then went up further. Now it's actually broken this particular VWAP, so it's actually still uh, in downtrend. Let's see, HDFC Bank. Okay, so if we look at it from the top over here, let's see what it's doing. Okay, it's trying to break that VWAP, which, so typically if you draw it from the top, it serves as a resistance, and if you draw it from a bottom, which might be a local low or something over here. Okay, it's taken a little bit of support from here and bounced up. So this is something that, uh, while I used to look at what charts are doing, so when I go to my actual chart, anchor VWAP is plotted from the peaks and the bottoms on all my charts. But the key is that I while I look at the charts with anchored VWAP present, I don't necessarily trade the anchored VWAP because it's something that's not very easy to code, and I don't necessarily code it, trade anything that I can't code. So that's one of the things. But coming back to the text, any quick questions till now before I go back?
No, sir. Basically, in fact, you yourself said that
Uh,
you
you're,
cannot make it
you're,
automated.
you're breaking up, Anshuman. I'm barely able to hear you. Say that again.
So while using Anchor VWAP, you have to manually do it, right? So there is no automated system which can build it.
Correct. So right now, Anchor VWAP is typically traded manually. Even when I checked with Brian, he mentioned that it is something that he trades manually. He has multiple charts open at different time frames, and depending on what's happening on the larger time frame, he would probably then take this daily chart, go into the 15-minute, and see what's happening on the Anchor VWAP. Probably place something which is closer to the VWAP over here. And then on this particular trade, he would probably have gone short over here. Let's do this on a 5-minute time frame. And then you can see that, if there's a local top over here, the prices are below this
Screen is
long
not
term.
coming. Screen is not coming, sir.
Sorry. Yeah. So what I've done is so this is the daily VWAP that we had figured from this top. Okay. So what he would typically do is he would take this top, and if the prices are below this, then he would only be interested in a short trade, and then go into a 5-minute time frame where he would place an anchored VWAP from 5-minute top. Okay, and then from here you'd only take short trades if the prices are below this long term. So this yellow one is the long term one, this is the short term. So as soon as it breaks below this, it comes to test the 5-minute. So on the 5-minute you can take a short trade, and as soon as prices start moving back towards this direction, you probably exit and only look for short trades below. This is the long term, and this is the 5-minute one that we started from the local top over here. In either of those cases, you'd want to only take trades in the short direction. What you can also do is plot the VWAP, and then ensure that you take trades in the direction of what the anchor VWAP is telling you, which is on the longer term time frame. So as long as prices stay below this daily top that we had looked at, then you'd only look for short trades in that particular stock. Okay, after the prices move above this, you'd look for long trades. But if your time frame is 3 minutes or 5 minutes, then you would want to plot a VWAP on top of that to see what you do intraday. If you plot an anchored VWAP from a, larger position, then you'd probably take a swing trade that could stay for a few days, but again, in the direction of the longer term trend. Okay, so that's something that he does. So just be if you are interested in taking this forward and using anchored VWAP, then this is one of the ways that you can use that. Okay. Okay, perfect. So coming to the calculation. So calculation is quite simple. It's really uh, taking the share price at which the trade happened into the volume at that particular price. So 100 into 5 trades, 101 into 10 trades, 102 into 2 trades. You take all the price into volume, which is 500, 1010, and 102 into 2, which is 204. Okay, you sum it up and divide by the total volume traded, which is 70. Okay, so whatever that number comes to is the VWAP for that particular point of time. Okay, so basically what you're doing is dollars into the volume divided by the total number of shares for that particular period. Okay, so because VWAP starts at the beginning of each day, the starting point is at 0, and then it builds throughout the day. But anchored VWAP, because it starts at a particular point, it does not have to be at the beginning of each day. What happens is that all the volume and the prices that have been traded, that is what it will capture and then move during the entire period post where you set the anchor. Okay, so you can set an anchor based on an earning report. You can set it at the beginning of the year. You can set it at the IPO price for that particular stock, and you can also set it at major highs and lows as it forms on the chart to see whether the prices are now going up. Because what is it that the VWAP or the anchored VWAP is telling you? That everybody who suppose bought from the point of view of the earnings report is either making money on an average or losing money. So if this is the anchored VWAP and the prices are above that, it means that people who bought it at the time of the earning report, they're all making money. Okay, so they will actually start selling only if the anchored VWAP breaks, and on an average, all of them start losing money. So this is something that shows that from that particular anchor, what is it that the average player is doing? Are they making money or are they losing money? The summation of the numerator begins where the AVAP is anchored. So we saw that you can take it from a top, you can take it from an earnings, you can also take it from any major event, and from there on it takes all the calculations in terms of volume as well as price, and then the total volume of the shares that have been traded throughout that particular period from the beginning to where you are today. So because VWAP begins calculation at a chosen point, Okay, you can use it over multiple days. Okay, VWAP is something that is an intraday indicator, but at the same time, when you look at anchored VWAP, you can use this indicator over multiple days and not just on a single day. To achieve the most accurate calculations, VWAP uses the shortest time frame. Okay. Now, typically, if you have a seconds chart that you can use, that is always better than using a minute chart. But because it is an intraday indicator, you would want to use something that is giving you a clear direction on a very small time frame, and is the best thing to do. Most people that I know who use VWAP use it on a 3 minute time frame. Some even use it on a 1 minute time frame. But the smaller the period, the shorter the time frame, the better it is. Avoid having too many data periods compressed, so the chart is always clear and readable. Um, and As the candles and the bars become too compressed, what happens is that you're not able to differentiate what's happening on the chart. So it's at least for VWAP, especially because it is a intraday indicator. Anything north of 5 minutes is not very useful, because you'll see large bars forming and going on both sides of the VWAP, which might not give you a clear indication. If you have a 1 minute or a 3 minute plotted over there, there'll probably be uh, five of them compared to a 15-minute bar. So for intraday VWAP measurement, tick data, which is every single transaction, is the most accurate interval. So the lower that you can go, the better it is for intraday, intraday charts. But anchored VWAP, because it is not an intraday indicator, you can use longer time frames also. So you can even use it on a weekly time frame. It just depends on what is your trading horizon and what is your trading time frame. So tick data, which includes every single transaction, is most accurate because it will actually show you how the prices are moving above and below the VWAP. But obviously, you need to have your platform support that. A lot of platforms, while they support VWAP, they don't necessarily support anchored VWAP. So as an intraday scalper, 1 minute time is good enough to understand VWAP. Some people even use a 3 minute. It really depends on the time and the trading strategy that you have to make sure that you're able to get the best out of VWAP or from anchored VWAP. Any questions till now?
Sir, you shown us the anchored VWAP on a larger time frame, the top highs and low. But this text is also saying something about so how do
Okay,
we see?
Anshul, I just don't think your mic is working properly. It's breaking up and there's a lot of interference. Why don't you type in the question in the chat? I'll try to answer that.
Okay,
Okay, sorry about that. So I'll take that question once it comes up on the chat. Anybody else? Okay, so let's go ahead. So price, volume, and time. Okay, VWAP as well as anchored VWAP takes into account all the three components. As a technical analyst, there's nothing else that we are bothered about. So it's either price, volume, time, any indicator that you have. Can we see anchored VWAP and VWAP together on TV? Yes, you can. If I quickly go back to trading view, I'll just show you. So over here, if you see this blue line, the blue line is the VWAP. I can change it to something that's more visible. Okay, so this white line that you're seeing over here is the VWAP that starts at the beginning of the day. Anchored VWAP is something that we plotted, and I can probably put an anchored VWAP even from over here, which is the beginning of this particular day. And you can see that the yellow line is the anchored VWAP. The white one, the indicator, is the VWAP that will restart on a daily basis. The anchor VWAP would, if I've started this anchor VWAP from the beginning of the day over here, for the first day, you can actually see that it is overlapping with the VWAP. because on the first day, because this is where the zero calculation started, both VWAP and anchor VWAP will be at the same place, but after that they will deviate. Okay, so this is the VWAP, which again started a fresh calculation from day two, but this one is taking the last day's calculation into account and then moving forward. So you can actually see that you can plot both VWAP as well as anchored VWAP on the same chart in TradingView, but this is the anchor VWAP that takes a particular point of time as the starting point, and then takes the accumulated data rather than VWAP, which starts afresh every day. Okay, so if I actually look at a trader, okay, everything, all the indicators, all our judgment, everything that we want to do, our strategies are only based on these three parameters: price, volume, and time. Okay, there's nothing else that really matters to us. And from that point of view, VWAP and anchored VWAP are really very useful tools because it combines both price and volume along with time on a single chart. Okay, so you have a lot of indicators that are volume indicators, there are a lot of price indicators, but VWAP is the one indicator that takes into account both price as well as volumes. So, price is how we keep score, and that's something that you'll hear from a lot of traders. They don't really care about how much money they're making. It's just a tool that tells them how good or bad they're doing in terms of their trading strategy. And you know, there's nothing subjective about the measurement. You're either making money or you're losing money, and volume is what causes the price to change. Okay, so volume is really demand and supply. If you look at it from that point of view, are there people who are willing to buy that particular stock? Are there people who are willing to sell that stock? And then that drives the prices either upwards or downwards. Okay, so one of the most common questions that we see is whether um, there was buying volume or there was selling volume in the trades that we've taken. uh, what actually happens, and people don't understand that for every buyer you need to have a seller. So at each and every point there will be a buyer as well as a seller. So the key thing to figure out is that who is in control. Okay, whether the sellers are in control or the buyers are in control, and both VWAP as well as anchored VWAP are able to show us who is in control. And the way to look at it is really dependent on the slope of the VWAP or the anchored VWAP. So if the slope is downward sloping, which means that the sellers are in control. If the VWAP is upward sloping or the anchored VWAP is upward sloping, that means the buyers are in control. Okay, so that's one thing that it clearly shows. There's one other indicator, probably you can research it separately, which is called volume delta. Okay, basically, again, not relevant to the course, but I just wanted to share that with you in terms of whether there's more buying pressure or selling pressure. Volume delta really looks at the difference between the volume that is or the trades that have been taking place at market price versus limit price. So you can all see the volume that has been traded, but you don't know whether that trade has happened at market price or at limit price. So if the trade has taken at limit price, that means that the buyer is willing to wait for his or her limit to hit. But somebody who's willing to buy at a market price would typically tend to push the prices upwards. Somebody who's willing to sell at market price would typically push the market downwards, and that also is a good indicator if somebody is interested to actually see which is the direction that the markets would move, and then take the trades based on that. Okay, and that is something that has recently become available in TradingView. But again, there are certain thresholds if you're researching market volume uh, volume delta. There's some certain thresholds, and it depends on instrument to instrument. What is the normal volume? If the volume increases beyond a particular threshold, that is where more buyers or sellers are coming in. So coming back to volume weighted average price and anchored VWAP. The more volume that trades at a certain price level, the greater the weight of that price level in terms of anchored VWAP and VWAP. So if you have 100 price level and there are 1000 trades, okay, if there's 5 trades at 105, it would not move the anchored VWAP significantly upward. It will probably move a little bit, but it won't really matter because the weight of these 1000 trades is so much more than these 5 trades that that have taken place at a higher price. Okay, so one of the things that anchored VWAP or even the VWAP does take into account is the volume, and because of that, if there's a lot of volume that is there at one particular price point, it would be very difficult for the VWAP to move away from that, even if the prices have moved away. So the two things that you need to remember: if somebody has been trading options in the Indian market, what you see is that the final price of that option, okay, is not always the closing price of that particular day. Okay, what happens is that for valuing that option and valuing uh, the and this is true for the expiry date, for valuing that option, what happens is that they take the VWAP for the last 30 minutes of trade and then calculate what is the final price of that option, because it is very easy to move prices in one direction or the other in the last few minutes of the trade. Okay, so instead of taking just the last few minutes of the trade and the closing price, what the indexes have done is to take the final closing price of an option as the volume weighted average price of the last 30 minutes. So at 3 p.m., you'll actually see a different behavior in a lot of options, or just before 3 p.m., you'll start seeing that, because after 3 p.m., it would be the volume weighted average price. So even if you look at suppose an option that is supposed to expire out of the money. So suppose it's trading at 0.5 50 paisa at a point of time, zero point 0.5 rupees. Okay, so suppose this is at 22 100. Okay, and this is at uh, 1459. Okay, so this is where the index is trading, and suppose the index closed at 22 150. Okay, now this option was 50 rupees in the money at this point of time, but you'll still see the price that it will close at would be probably 15 or 16 rupees, because they're not only taking the closing price at 1530, they're taking the average price at which or VWAP of the trade between 3 p.m. and 3:30 p.m. And that VWAP would probably be at 22,115 rather than 22,150. And that's one of the things that once you're trading options, you'll be able to realize that this is one place where VWAP is impacting us on a day-to-day basis. The second place where it does impact us is that a lot of institutional investors really look at trying to be as close to the VWAP as possible for their trades. So during the day, if they want to take trades and if the VWAP is moving like this and prices are moving like this is where they will try to take most of the trades so that they do not move the VWAP a lot. Okay, what I said was that, okay, 1000 trades at 100 rupees. Now, if somebody wants to take another trade at 101, the institutional investors would try to keep their own buying and selling as close to the VWAP as possible, because that, in a way, also uh, you know uh, does not allow other market participants to figure out what is the direction in which uh, the large players are positioned. Because if you take the trade exactly at VWAP, then you don't know whether they're trying to push the prices upward or downward. So those are two actual practical ways in which you'd see VWAP impacting us in our daily trades. So traditional volume analysis tells us that volume should expand in the direction of the trend and diminish when retracements happen. Okay, it does help us in terms of direction, but what happens is that these guidelines help us determine if the demand expands with prices or whether the demand is going down. So if the prices are going up, if you see smaller bars in terms of volume, what you can say is that okay, there's a divergence between volume and the actual movement of the price. There might be a situation where the volume is not, you know, the volume is contradicting the price, and because of which you'd probably be cautious and wait for volume to provide you to the direction or the prices to break down to take a short trade. So typically, if the volume is also expanding as prices rise, it means that the volume is confirming the direction of that move, and that's what they mean by volume is expanding. Or if the volume is going down, that means that the trend will not continue. These guidelines help us determine if the demand expands with price or if it contracts. If it contracts, then we should be alert of a potential reversal. Okay, so if the graph is something like this, the prices are going up, but the volume is going down, that means that the prices can reverse, and that is a point for us to be alert. And same thing that we saw yesterday in a lot of charts where we were looking at what happened to different markets in the US. What was it that was being seen in terms of new high, new lows, etc., versus the actual S&P index. The VWAP and anchor VWAP show the true relationship of who has a control from any particular anchor point, whether to the buyers or the sellers. Okay, so let's look at what is being seen on a chart. So here we have 15-minute candlesticks, okay, and anchored VWAP from the first candlestick. So if you actually look at it, this is the first candlestick. Okay, this is where the anchored VWAP has been placed. Now, over here, they've expanded it based on the 15-minute chart on 4 days of price pattern. Okay, so you have Tuesday, which is this Tuesday over here, Wednesday, Thursday, Friday, and this is all 15 minutes. Here you have the daily chart. Now, if you look at the anchored VWAP as well as the daily charts, what you'll see is that over here, prices went down on day one, went up, went down, went up. Okay, but if you expand that, what you'll see is that the anchored VWAP that started on Tuesday, okay, which was a low because this was where the high was on the previous day, or this is where the close was on the previous day, and then the markets fell on Tuesday, and then it went up all the way through Friday. So you can see that while the anchor VWAP was plotted, once the anchor VWAP was broken on the upside, the buyers got the control, and twice the anchor VWAP was tested over here, and after a successful test, the prices moved upwards, and the bears could not take control. So on the left, there are daily candles with the largest two volume days occurring on down days. So if you actually look at it, these are the days where you had high volumes. Okay, this traditionally is bearish. Okay, because every time there is a buyer, there's also a seller. So the bars and the color of the bars are really dependent on the price movement of that day. So if there was a red candle, then the bar will be red. If it was a green candle, then the bar will be green. So traditionally, we look at it as something that would give us a bearish signal. But if you actually look at the 4 days, okay, and the anchored VWAP, you can see that even with the larger volumes on down days, the buyers were in control. Okay, why? Because the larger players will allow the prices to fall. Okay, and this is where they would have probably entered, or they would have probably, if they were buying, they would have entered below the VWAP so that they can push the prices upwards and rake in higher profits. Okay, so when the price is above VWAP and is moving higher, it indicates that the buyers are in control. This was the case for day 2, 3, and 4. So day 1, the sellers were in control, but as soon as the sellers lost control and the prices moved above VWAP, then the buyers did not allow it to come back down. And what you can see is that even though Thursday, which is this day over here, okay, the volumes were going, sorry, the prices were going down, but the price stayed above VWAP throughout and tested the VWAP and then jumped up from there. Okay, so uh, VWAP actually functions as a support and resistance to prices. If it is broken, then there'll be a sharp move on either side of the VWAP. Typically, that the way it happens in any support and resistance. And similarly, if it is broken on the downs, if it's broken on the downside, then price will move down further. If it's broken on the upside, the price will rise up very quickly. And that is why you can see that there's a gap over here as soon as the VWAP was tested on the Thursday, and then prices started moving up very quickly. So this gap that you see is this gap that happened after the close of Thursday and the opening on Friday. Any questions till now? Okay. So that's and part of the reason why VWAP is so sticky, as in why prices stay closer to the VWAP is because a lot of institutional traders make trades around the VWAP. So there's huge volume that is traded closer to the VWAP than away from the VWAP. And typically, if the volumes are moving away from the VWAP and it's moving in the price is moving away from the VWAP and it's moving with higher volume, it means that the institutions are willing to pay a higher price and willing to go away from the VWAP and still go ahead and buy that particular share. Okay, time is obviously constant. It remains the same on any chart, and typically in the US, markets start at 9:30 a.m. and close at 4 p.m. And if we use VWAP, we are able to organize our insights and information based on the opening and the closing of the market. But again, as AVWAP allows us to, anchored VWAP allows us to look at price movement from any point on the chart. It helps us to figure out things that are there from meaningful highs and lows. So we looked at earnings report, we looked at meaningful highs and lows. Sometimes they also put in Federal Reserve meetings. You can also put in the date of the Ukraine war, whatever you want as a starting point for an anchored VWAP, something that you feel would be impacting the prices. You can use that as an anchor and then see what is it that the prices are doing from that particular anchor. Okay, VWAP and anchor VWAP in a way are sentiment indicators. Okay, they basically try to look at the collective psychology of all the market participants, because what happens is that if this is how the VWAP is forming, it means that the average player from this particular point, okay, for that particular day, for that particular week, or from the time the earnings report has come out, is either moving up or is losing money, and the price of that particular stock is going down. So basically what it says is that, okay, if I've taken up 500 shares of a particular company at a particular price, if somebody else has taken up 1,000 shares at probably the same price, and if it starts going down, means on an average both of us are losing money. If I've purchased those 500 at a lower price, somebody else has purchased it at a higher price. That means that, if the prices today are above VWAP, that means on an average, while the prices are going down, but there's some people who are making money, there's some who are losing money. But if the prices are over here, which is below the VWAP, on an average, most people who have invested in that particular share are losing money. And that's one of the reasons that VWAP as well as anchored VWAP are also considered to be sentiment indicators, because it tells us what is the amount of pain that is there in the market, or are a lot of players making money, and that brings in different behaviors in the market. The problem with most sentiment indicator is how difficult it is to accurately measure what people are doing versus where they're actually putting their money. But VWAP and anchored VWAP actually allows you to figure out the supply as well as demand from any particular time frame, because it combines both price and volume. It means that somebody is either willing to pay a high price or willing to pay a normal price, but willing to pick up a lot of volume at that particular price. So that's one of the things that one needs to take into account as they're looking at VWAP and anchored VWAP, that it also shows the sentiment in the market. Okay, so a lot of times where somebody is uh, just looking at the fact that hey, where is it that the institutions are buying, that is something that will tell you what is it that the average player is doing in the market. Are they making money or losing money? Again, that is something that will tell you whether the average player is making or losing money. So today the VWAP is still used as a benchmark for order execution. Uh, but obviously, as with a lot of other tools in the market, it is something that is evolving. There are people who are trying to figure out how to use it best. Uh, it is used both by discretionary traders as well as algo traders, and uh, you know in most cases, VWAP is used as a intraday tool, and a lot of intraday scalpers would be using VWAP as an indicator around what is the what are the large players doing, whether the buyers are in control or the sellers are in control. AVAP, on the other hand, shows the relationship between price and volume over a particular time period. It's not limited to an intraday. So it kind of tells us with a lot of certainty who is gaining or losing from that particular point. So if it is from an earnings, whether the average player in the market is making money from that day. So anybody who purchased on that day to right now, are they making money or not? Okay. So our job really is to just make sure that we understand what the data is telling us and make sure that we trade with those data points in mind. So let's look at the next slide, so which is figure 4.13. It's a 1 minute chart which shows two different VWAP levels, one from the top and one from the bottom. And you know, it's very easy to determine the daily VWAP. It's you know, it starts from the beginning of each day, but anchor VWAP is drawn from any major high or low, or even from any results. So if you look at what is there over here, okay, so the VWAP is in purple, and the anchor VWAP from the day's low is in green. Okay, so on this particular chart, both the anchored VWAP, which is this green one, and the VWAP, which is the purple one, both of them have been plotted on an intraday scale. Okay, while the VWAP always starts at the beginning of the day, anchored VWAP has been plotted from the bottom of the day. And what you can see is that from here, okay, this is the anchored VWAP, and the prices are taking support at the anchored VWAP over here and the anchored VWAP over here. So from the lows of the day, okay, most of the people are making money. So somebody who entered over here, somebody who entered over here, they are making money at an overall level, and they're taking support from the anchored VWAP, which was from the bottom of that day, and then riding that wave upwards. Okay, even though the VWAP shows that prices are falling, okay, over here it's stabilized, but if you place an anchored VWAP line over here, what it will show is that prices are taking the support of the anchored VWAP and then moving upwards. Okay, uh, how do we use volume delta? There are a lot of YouTube videos, Anshuman, I'll let you go through that. But basically, what you look at is that, okay, if this is the average volume delta that's being traded, and suddenly the volume delta moves up over here, or it goes down and it goes over here. So if you basically take a threshold on Nifty, I typically take 40,000 contracts on a 5 minute chart. So if it crosses 40,000 contracts on the upside and the price is also going up, that means there's a lot of buying pressure. If the prices are going down and the number of contract, the volume delta exceeds 40,000 on a 5 minute chart, then I would typically take that as a bearish signal and a trade on the short side versus the long side. And this data also changes during the day. So you just need to be very careful on how you're trading it. So go deeper on this if you want to understand volume delta. But this again is a good tool for somebody who wants to trade on the volume, especially on an intraday basis. Okay. So any questions till now? So before we come to standard deviation bands, let's take a 5 minute break, and we'll come at 2 past 11 and continue the rest of the chapter. Okay, sorry about the delay. Let's go ahead and start. But any quick questions before we start? Okay, so till now we saw VWAP as a single line, okay, which basically told us what is the volume weighted average price. But there's also something called standard deviation bands. So first, let's go to TradingView and see that, and then we'll come back to study what it is. Okay, so I'll remove all the drawings over here. Okay, so we have the VWAP that we saw, and one of the things that we removed was this. So you can have one or two bands over here. So basically what these bands are showing, let me go to the 1 minute time frame. Okay, and what you can see over here is that the white line is the VWAP, volume weighted average price. The green lines are plus minus one standard deviation. And what you can see is that the times that the prices have bounced off the standard deviation lines and gone to the other end. And if it stayed above that, it has gone all the way to the second standard deviation, which is this particular line. And sometimes when it had to retrace, it would retrace either from the first standard deviation or the second standard deviation. And if you look at the next day also, it went, went crossed the second standard deviation line. And then after retouch of that, it came back closer to the VWAP. Okay, so these standard deviation lines are nothing but how far and how far the prices have moved away from the VWAP and how that can play into your trading. So let's go back to the text and see what it tells us about these lines, and then we'll come back to trading view and see how it's actually showing up on our charts. Okay, so the addition of standard deviation bands, it's very similar to what you do with Bollinger Bands. Okay, so it's no different. Uh, but if we use standard deviation lines on VWAP and anchored VWAP, it kind of shows us, what is the high or the extreme level for VWAP or anchored VWAP. And that kind of tells us that on an intraday basis, where is it that the market is most likely to reverse. Okay, now the market might not always reverse from there, and that is what you have your stop losses for. Okay, so if you're taking a trending trade, okay, and suppose this is the standard deviation, this being the standard deviation, the prices can keep rising. So if you're taking a reversal trade and the prices have started rising beyond the band, then you need to take your stop loss and exit that particular trade. If you're taking a trending trade, you usually want to start that from the VWAP rather than from the boundaries. So if the boundaries typically or the standard deviation bands should typically be looked at as a mean reversion tool rather than a trending tool. So, Bollinger Band can be looked at both as a mean reversion as well as a trending tool. But over here, it's best to look at it as overbought and oversold and try to take a trade uh, which is against the trend at that particular point of time. Okay. The width of the band reflects the current market volatility, and again, similar to uh, what happens on Bollinger Band, the bands are based on standard deviation. Okay, and standard deviation reflects what is the market volatility. Okay, so if the bands expand, it shows that there's more volatility in the market. If they contract, it shows that the market is in consolidation, and as and when that band breaks, that is where you'd want to take a new position. So typically you'd want the bands to come closer and the prices to stay there. And if it breaks, then you take the trade in that direction. So typically when we calculate the band, you calculate the standard deviation around the VWAP or standard anchored VWAP. Okay. So you take the OHLC price, which is nothing but open, high, low, close. Okay, multiply that volume with volume, or for the tick data, whichever you have or whatever your chart platform uses, and then go ahead and figure out how far the prices can go from that particular VWAP. So if it If it's a very volatile day, the bands will be further apart. If it is not a volatile day, the bands will be closer to each other. Okay, so let's look at what they've given over here. A 1 minute chart on S&P 500 ETF SPY, and you know they've added both the one standard deviation as well as the two standard deviation band around the VWAP. Okay, if the volatility increased, okay, the range of those two bands expanded, okay, and then the volatility decreased, because of which there was a contraction of those bands. So if you actually look at it, this is the start of the day, the opening price. It is a 1 minute chart, and you can see that as prices started moving down, the bands also started expanding. Okay, the slope of the VWAP told you that the prices are probably moving in the downward direction, but somewhere over here it was rejected from the band, and the ideal trade would have been to take a trade towards the VWAP. And again over here, it did not breach the one standard deviation, and then started moving down again towards the lower end of the band. And if it is not a trending day, then you'd see it probably moving within the bands. If it is a trending day, what will happen is that the prices will typically break the band and move outside the band. So let's go to trading view again and see what we can see on an actual chart. I probably put Nifty again over here. Uh, okay, and I remove. So the blue line is the VWAP, and I put in one band, and now I'm putting in the second band. What you can see over here is, if somebody remembers what happened on Tuesday and Thursday, and even on Monday, actually, Nifty moved in a very narrow range, and you can see these bands being very close to each other. Friday, so Wednesday was a holiday. Friday is where the actual trend started, which was on the downside. And you can see that the band expanded because of the fact that the standard deviation on those of the index actually increased. And that kind of told you in a way that it would be a trending day. Okay, where the prices were rejected from this particular point when it tried to come back towards the VWAP, and then it kept moving down, broke the one standard deviation, and then probably even broke the two standard deviation before closing somewhere over here. But on the days where it is range bound, you can see that the bands are very narrow, and every time it comes towards the band, it tries to go back to the VWAP. Similarly, over here, it went to the band, it came back to the VWAP, came to the other end of the band, went crossed the VWAP again, and went to the upper end of the band. So typically on the range bound days, this is what you'll see. One, the band will be very narrow, and then you'll see moves both towards and away from the band VWAP. So this is another day which was a range bound day, and you can see that it took support from the VWAP. It stayed above the VWAP, but did not move a lot from there. So depending on how you want to trade this, you can build your own trading plans and use VWAP as one of the tools that can be a part of your trading strategy, or it can just be a tool that tells you what is the direction of the trade, whether it is in line with what the markets are showing you. It's just another indicator that you can use. And typically, if you have more uh, if you have more indicators that are aligning to your views, it's always better and more conviction for that trade. Okay. Questions? Perfect. So I think we just have the last three slides to go. So we should be able to complete this class within 1.5 hours. And then we'll start with the second chapter at, in the evening class at 6:30 p.m. So the VWAP and the anchored VWAP, okay, are not just based on the two-dimensional component of price and time, okay, which is the way we have most of the moving averages. Okay, they also take into account the volume of activity. Okay, because it is a multiplication of volume into price, so it is not only a traditional two-dimensional move, but it also takes into account the volume, which is typically plotted on a separate chart at the bottom. All three components are combined into one single indicator, and that is why it is not just a two-dimensional indicator based on volume and time, sorry, based on price and time. It also includes volume, which is the amount of activity that has happened on that particular stock. So uh, the property of VWAP and AVWAP uh, comes as more data is averaged into the study. So what happens is that, in the beginning of the day, okay, what you will see is that the prices will be very close to the VWAP, and the VWAP will move very quickly. It will move up and down depending on how the prices are fluctuating and how the volumes are. But as you go towards the latter part of the day, you'll see that the VWAP is more stable. And the reason that it is stable is that because a lot of volume has already been traded. For somebody to move the VWAP at this particular point of time, they'll have to nullify all the volume that has been traded throughout the earlier part of the day, and only then can they move the VWAP upwards. So one of the things that you will see is that typically in the beginning of the day, the VWAP can move up or down, the slope can change, but as you go toward the latter part of the day, it will become very stable. It can keep going down, it can keep going up, but it becomes very stable because uh, in a way, the volume that is traded towards the end of the day, it has to be enough to offset what happened for the entire morning to be able to change the direction of the VWAP. Okay, it combines price, volume, and time, and gives us a blended view of whether the buyers or the sellers are in control. And as psychologist Brett Steenbarger calls it, it's a gauge of the emerging sentiment. Okay, so it tells you what is it that most of the players in the market are doing. Are they buying or are they selling? And what is the direction that they want to take? Okay, so this kind of helps us, you know, get better entries. It This is very important. It helps us cut our losers because if the direction of the VWAP is not in the direction of the trade that we have taken. If we've taken a long trade, okay, but the VWAP is actually trending downwards, then first thing would be for you to cut your losses and then figure out what is the direction of the market. Okay. Similarly, if we've taken a short trade and the VWAP is going down, we could probably hold on to our winners longer. Okay. So it really depends on how you're using the VWAP. Most of the traders, especially people who do intraday scalping, they use VWAP, but they take a lot of very quick trades rather than waiting for everything to play out. Okay, so they might look at VWAP over here. If prices move over here, they take a short trade expecting the prices to come back to the VWAP. They'll exit a large portion over here. They'll probably exit 50% over here. And then, depending on if this VWAP holds and the prices move up again, they'll take a long trade, wait for the prices to go up. Probably at a particular point when it's turned, they'll take a short trade and exit their long positions. So there are a lot of very quick trades that they take because, again, that's the nature of scalping. But the key is that VWAP kind of gives us direction in terms of what is happening in the market, and it also allows us, insight into whether we need to ride a trend or whether we want to cut our losses and wait for the next trade to arise. So there are few rules that one needs to keep into account when prices are above an advancing VWAP. Okay, so when we say advancing VWAP, it means or VWAP or anchored VWAP, it means the VWAP is sloping upwards. So if prices are above this, okay, what it shows is that the buyers are in control and the average price is increasing. Okay, so which means that that particular trend where prices are above VWAP is actually bullish. When the prices are below a declining VWAP, okay, the VWAP is going down and you have prices which are coming to the VWAP and being rejected over there each time. Okay, sellers are in control and the average price is decreasing. And this is something that's very bearish for the market. When prices oscillate both above and below, it indicates that there's a push and pull between the bears and the bulls. The market has not decided which is the direction. So typically, it's a good time to let the prices to develop further and ride out the market uncertainty till the time you actually get a direction. Okay. Now, obviously, as with a lot of other indicators, VWAP as well as anchored VWAP is looked at differently by different participants. I told you that if you're trying to take a trending trade, you'd want the prices to come back to the VWAP and then take a trade in assuming that the prices will move in the direction that the VWAP is, which means that if the VWAP is upward sloping, that you'd want to take, then you'd want to take a long trade. If it is downward sloping, you'd wait for prices to probably cross the VWAP and try to take a short trade over here. Now, you might want to take a pending trade, but somebody else who sees this as the VWAP has seen the prices go up over here would want to take a short trade over here. Okay, so the different market participants who would want to try and trade this differently. Okay, so if somebody is a mean reversion trader, they'd prefer this trade than from here trying to take a trending trade. Somebody who's a trend follower would probably want to take a trend as soon as the VWAP holds as a support. Okay, so a long momentum participant will view positive slope of the VWAP or anchored VWAP as a confirmation that the position is working and they want to stay involved. If the momentum holder observes the prices below a declining VWAP or an anchored VWAP, they will not want to take a new long position and might consider even selling their longs and probably take a short position. An institutional trader, which are typically the large players, okay, when they try to fill their buy or even their sell orders, okay, uh, they would want to wait for a certain number of weeks. So typically, they don't just come in and buy all the position in one shot. They wait for prices to come to the level at which they want to buy. Okay, and sometimes even if they want to buy, okay, what they do is that if prices have moved away from where they want to buy, they will start selling and push the prices to this level where they would want to buy. So they would start selling some of their holdings to make sure that the prices come back to the level at which they want to buy. Only if they've been able to buy everything that they want to buy at this level will they allow the prices to rise further. Because every time the prices go up, they would come in and sell and move the prices back to the level at which they would want to buy. So any institutional trader, when they're trying to fill a large order, one, it takes a long time because if they come in and try and place a very large buy order, the prices will move up and there won't be enough sellers in the market. So what they do is they typically come in, they sell, push the prices down. So people who've gone long, their stop losses might be hit. There'll be more supply that will come in, and they'll be able to get whatever they want to buy. So they will buy fewer shares when the VWAP is rising. Okay, VWAP or anchored VWAP is rising because they would want their purchases to be at the prices that they want to trade at. They don't want to one show their hand, okay, which means that other market participants will know that okay, a large player, a pension fund or a hedge fund wants to buy this particular stock, so the prices will move up further. So what they do is they typically keep the prices stable at a particular point till the time uh, they're able to buy everything that they want to buy. When the stock is below a declining VWAP or AVWAP, the institutional buyer will become more aggressive and they will keep buying because, from their point of view, they're getting that share in a discount. So, if this is the price that they were willing to buy and the anchor VWAP is trending downwards and the prices are below this particular price point, then they'll keep buying and trying to fill their kitty because of the fact that they feel that the value is at this price and they're getting something at below the value and they would want to keep accumulating that particular share. Okay, I think this is the last slide for this class. So what are the rules or the principles for interpreting VWAP and anchored VWAP? We did discuss about the fact that if it is a downward sloping VWAP, then it typically means that the sellers are in control. If it's upward sloping, it means the buyers are in control. From a visual reference point, you compare the current price to understand what is it that the market participants are doing. Okay, so typically when you look at prices that are above VWAP or prices that are below VWAP, from just looking at the prices, you'll be able to see what is it that the market participants are trying to do. It is not always meant as an action plan, action point, but as a level of interest to study the price action more closely. Okay, again, you need to build your own trading strategies with VWAP. As I said even yesterday, uh, just because there's a divergence does not mean that you take a short position. Okay, you need to wait for the actual prices to move in a particular direction. So similarly, VWAP is not something that you trade that tells you where's the level of interest, but your trading strategy can be a mean reversion trading strategy or a trend following trading strategy, but a lot will depend on what the VWAP is doing. So watch the VWAP, understand what the implications are, but your trading strategy can be, and again, if you're suppose this is how the anchored VWAP is downward sloping and the prices have moved up over here, you are better off taking a short trade, but you can't take that short trade over here. You can't take that short trade over here. You'll have to wait for something to break. Even if it's one candle that is red and the candles have been broken, this is where you'll take the trade to wait for prices to come back over here. So, you shouldn't be taking a short trade when the markets are still rising because you don't know how far it will rise and when is it that the VWAP will start trending upwards from there. Okay, so just be careful about some of these things. VWAP, while it gives you an indication of where the buying and selling interests are, what is it that the market participants are doing. A downward sloping VWAP can also turn up even during the day. Okay, similarly, an upward sloping VWAP can turn downwards during the day. So just make sure that you have the right trading strategy. Uh, I'll come back to your question in a minute, Anshuman. Uh, once you identify what is it that uh, you'd want to trade, you can use VWAP as another indicator that tells you whether you are on the right side of the trade or not. In the short term, VWAP and anchored VWAP levels can be actionable because again, at least VWAP is a intraday indicator. Long term VWAP is anchored VWAP is something that tells you what most of the market participants are doing from a particular point of interest, a top or a bottom, even an IPO or even from a result. VWAP levels can act as support or resistance, and that's what we saw on the chart. That if it is broken, then prices tend to move beyond the VWAP. Sometimes it just acts as a support, and then the prices move up from there. Sometimes if it is a declining VWAP, it also acts as a resistance and pushes the prices down much further. Okay, we want to know if the prices are above or below the VWAP and by how much to avoid chasing a move. And again, this is very important. If this is how the VWAP is behaving, if the prices are over here, you wouldn't want to enter a long trade at this point of time. Okay, primarily the reason being that the prices are already away from the VWAP. There's a tendency for it to first come to the VWAP, take support, and then move up. So just be very careful about this, that you don't take a short position a long position when the prices are significantly away above the VWAP. So that's something that you'd want to just make sure, because there's a higher tendency for the prices to come down from here than to go up. And then we want to be aware of the slope of ascent or descent from the starting point. So if it's going down, that means the sellers are in control. If it's going up, that means the buyers are in control. So that's pretty much for today's class. Any quick questions? Okay, perfect. I'll quickly take your question, Anshuman. We can probably just do it over here. We don't need a separate class. So basically, what Andrew Clenow is doing in his book, that's a pretty straightforward, you know, uh, momentum strategy, where he's basically looking at the log coefficient of how the prices have moved on the previous day versus the current day, and I think he's taking a 90-day time period. So over the last 3 months, if today's price is higher than the last 90-day price, he takes the log coefficient of that particular number to come up with. Let me just get one more thing going. 1 second. Yeah, I'm just pulling up what I've done in Google Sheets, and then probably if that comes up, it will be easier to explain. Okay. So what he's done is that he is actually taking the log coefficient. So basically, what is the context in which he's speaking about momentum? So his point is that you can't catch the first breakout in most cases. So what you need to do is to figure out stocks that have moved up, and then understand whether they are in a consolidation range or not, and then try to catch them when they are in that consolidation range, because in most cases they will break out in the direction of the initial breakout. So stocks first should have gone up. That is what the log function calculates. Then they'll look at what is it that it is doing in terms of the slope of that line. And then I think there's another piece of the formula that talks about adjusted slope, and then it does the selection. So let me just share what I have done, and probably that will help you do the same thing. Okay, let me know if you can see my Google Sheets. Yeah. So here, what I've done is, again, this is quite elaborate. So I have a start date and an end date. I think this is about 6 months worth of data, 187 days. I can change this over here. And then over here, I have, so I start with Nifty, but then I have all the Nifty 500 stocks that I've listed. And then there's a formula, I think over here, there's still loading, which is the price from and to date. So start price is today, which is 3/2, and the end price is 187 days in the past. So it's 8/26, 2024. And then at the bottom, if you go down, I'm still calculating something. So it will be a little slow, but you can see at the bottom, you'll have the price for the 28th of February. Okay. And then you need to take the log of the values that are on this particular sheet, which I've done on the next sheet. So instead of just using directly what he's put in his sheet, I have made sure that I calculate the same values but on different sheets, because it's not very easy to put it in a single Excel, because that single Excel will just do it for one single stock. Okay, I think it's still calculating some of the values, that's why it's not updated yet. This is a little slow. I'm not very happy with the time that I have to close it and reopen it for it to give me the exact results that I want. But this is all automated in terms of Google Sheets getting the data from. So it shows loading over here. So it's still doing some calculations. I don't know what that is. But as soon as it completes the uh, entire capture of those data points, what it will do is it will do the log data. There is a formula that he has on slopes. So there are basically three formulas, and all those three formulas are in the three sheets. And based on what the adjusted slope is, there is this sheet called auto selection, where uh, the actual stocks in an so in a descending order will come up. Let me quickly open a different one if this is not calculating. So sometimes you just have to open it and leave it open for it to do the calculations and then come back with the output. Uh, yeah, but it saves you a lot of time and effort to do this manually every day, or probably even have a sheet that captures the closing price on each day. Nope, hasn't come up yet. Let me try one more thing. Okay, I should have probably just opened it much earlier and left it. Uh, do you do? No, I don't have to do anything manually on this one, Anshuman. I just open it. Sometimes it just takes a lot of time. Probably it's also to do with the Google servers. And one of the things that I've seen is that it works better on a Windows laptop than on Apple. It usually is faster. I don't know why, but I've seen that work better. So every time I've opened it on my Windows laptop, it is very quick in terms of giving me the output. Uh, so I don't need to do it manually, but yes, I typically take a look at the stocks that have come up on a weekly basis. And what has been defined in the book is that you just switch from the stocks that are there on a 1 week to the next week, and just do that blindly. But I also look at what the charts are telling me before I buy a stock or exit a stock. So there is that bit of manual intervention, and I don't just follow the formula blindly, because there are times where uh, if you just go by the formula, that stock will go out of your bucket much later than what you'd be able to do if you make sure that you look at the chart and then decide what to do. Give me 1 second. Okay. Okay. So here, all this data has come up. Then there's this sheet on log data. Come on. Okay. While it's showing as blank, I think the data would be somewhere below. No, it's still not there. Okay. So basically, let's see. Is the justice slope coming up? It's still rotating over here, so probably there's something that is still calculating. Okay. Let's look at S&P. Uh, all of them are still running and running. But anyway, so what it does is that it does some calculation on each of these sheets, and then automatically selects the one that has the best ranking based on the adjusted slope. And and these are the ones that it has picked up for me. I keep a manual count of which are the ones that are new versus old, where for a particular week I just capture the ones that are there already that has come up. It goes to a different sheet, and then here the new versus old or existing only captures the fact that whether it was already there for a previous week or not. And then yeah, these are just some comparison that I run for different weeks. So you can build that. The formula is pretty straightforward, and it can be built on Google Sheets, where just by opening that sheet, you'd be able to get the entire uh, the entire selection in terms of what is it that. And even over here, I've calculated the adjusted slope, but that number is coming from a different sheet. That's actually coming from over here. Let me see why that's not showing up. Let's go to this one, SNP. Nope. Even this is still calculating. This one is still calculating. So there are different ones that I have. So this is on Nifty 1000. This one is on small caps. This is on Nifty 500. And you can get the selection of the stocks automatically once it opens and it runs. But I'll stop over here, Anshuman, and yeah, happy to delve further into this. Uh, First, you need to make sure that you start getting the data. So once you put the Google Finance formula, you'll get data for the duration that you're looking at. Once you get the data, then you can work on the formulas. The challenge with the formula is that, yeah, okay. One second, I think one of the sheet has opened up. So the challenge with the formula is that the way he's described it in the book, you have one column and then of data points, and then you need to calculate all the different values, which if you're trying to calculate for multiple stocks, it becomes very difficult because you have to manually enter the data. So just take a look at this. So I have the raw data that's come up over here that comes up automatically based on the Google Finance form function. One second. Okay. Then the log data sheet does the calculation based on the formula that Andres now has. Oh man, let me close some of the other ones. Yeah. So here it is the log data, and then this formula. I think there's another formula which uh, is the slope. Now the slope cannot be just from the first number itself. It has to, as a moving average, it has to leave a few line items, and then it calculates the slope, uh, which again would be probably somewhere below over here. It calculates the adjusted slope over here, and uh, okay, I think this one is still, yeah. So it calculates the adjusted slope over here. That adjusted slope then is used to figure out which is the one that has the best adjusted slope. So 2.8 on this one, 2.66 on this one, 2.5, and then it picks up the actual stocks that come up over here based on whether, you know, and then I've put a formula where I can just copy all of this and then take it to my trading view and put it as a watch list. So can just copy it from here and put it as a watch list in trading view. Okay, with that, I'll stop over here. Any other question that anybody has? Oh, were you able to see my screen? Oh, I was not sharing. Let me just try again. So this is where it comes up. This is the adjusted slope. This is where the slope calculations are. Okay, and then this is where the log data is. Now there's some lines that are missing because again, as moving average, it will leave a few lines before it calculates the slope, because the slope is, I think, from day 1 through day 10, what is the slope that is coming up, and then based on the adjusted slope, it gives you the selection, which is the last one over here. So this is the adjusted slope, and depending on the adjusted slope, what is the stock that is the highest priority versus the second versus the third. Okay, so I'll stop over here, and then we'll talk more on anchored VWAP in the next class at 6 p.m. Thanks everyone. Bye bye.